Hi, and welcome to the Nonprofits Assistance Fund's Coffee Break webinar series, where Nonprofits Assistance Fund staff explain important financial management topics in short, easy-to-digest segments available for free whenever you need them at www.nonprofitsassistancefund.org. We're glad that you've chosen to view Balance Sheet Basics, what we have, what we owe, and what we're worth, and hope that you find it useful. At Nonprofits Assistance Fund, our mission is to build financially healthy nonprofits that foster community vitality. We help nonprofits in Minnesota and surrounding communities to build sustainable organizations by providing flexible financing, encouraging effective financial practices, and offering strategic guidance. Our online resources are free and available to nonprofit staff and board members everywhere. My name is Michael Anderson. I'm the Training Program Manager and a Loan Officer here at Nonprofits Assistance Fund, and I'm really glad you've joined us for the session on the balance sheet. So today in our Balance Sheet Basics Coffee Break webinar, we're going to talk about the contents of the balance sheet to get a better understanding of what the balance sheet is trying to tell us, and we're going to use a case study balance sheet to help understand the contents of the balance sheet. And while we do that, we're going to highlight some commonly used vocabulary and go over some key balance sheet terminology. And at the tail end of our Coffee Break webinar today, we'll point out some additional resources that can help you dig deeper into further understanding and analyzing your balance sheet. But before we dive into our balance sheet today, we're going to do a quick review of some of the core principles of financial reporting. So our financial reports for our organization should always be accurate and consistent. They should always be made available to us soon enough to be helpful for our organizational monitoring and planning. So oftentimes that means we're looking at monthly statements in a really timely manner and within a few weeks of each month end. And always making sure that we're understanding financial reports in the context of the organization's history and also in relationship to program activities, so that we're always connecting money and mission within our organization. So today we'll really highlight how can the balance sheet and the information on the balance sheet help us understand our current operations, help us understand what our future operations might entail to make sure that we're understanding the balance sheet in the context of our overall organization. The balance sheet is one of three really key financial reports that we should always be considering and understanding together and complementing one another. The balance sheet along with the income statement and our annual budget. Specifically today, we'll look at how the balance sheet and the income statement work together, but understanding that these three core components of organizational financial management and the quality of the information that they entail really are what leads to quality decision making within our organizations. So every balance sheet has three core sections of assets, liabilities, and net assets. Another way you can think about that is the asset section, meaning what we have as an organization or what we own, while liabilities are what we owe others, and our net assets are what we're worth. Now this term net assets is a unique term to nonprofit accounting, but it has a lot of synonyms. So your net assets really can also be represented by terms like equity, retained earnings, fund balance, or net worth. So know as we walk through our case example today, we're going to be using the term net assets, but the bottom section of your balance sheet that represents the difference between assets and liabilities might go by one of these other terms. So thinking about the three sections of our balance sheet of assets, liabilities, and net assets, or what we have, what we owe, and what we're worth, we can understand the fundamental equation that governs our balance sheet. Our assets equals our liabilities plus our net assets. Another way you can think about that exact same equation is assets minus liabilities equals net assets, or what we have, take away what we owe others, and we're left with what we're worth. In today's session, we're going to use a balance sheet from a fictional nonprofit called the Family Advocacy Network, or FAN. You can see here at FAN's balance sheet that it's highlighting that the financial assets and obligations are noted as a very specific date and time. So right there on the top of FAN's balance sheet, we see we're looking at a December 31st, 2010 statement. You can also start to see that the balance sheet is in fact organized into those three sections of assets, liabilities, and net assets. So we'll use this example throughout our session today, starting off with a discussion of assets. So the assets section of a balance sheet is organized into two different types of assets, current assets and long-term assets. And we can see here on FAN's example balance sheet, they do in fact have two different sections. Current assets and long-term assets, these have to do with how liquid an asset is. That is, how easily it can be converted into cash. So current assets are assets that are currently cash or will be converted to cash within the next 12 months. We can see here in FAN's balance sheet lines 1 through 5 some really common types of current assets. They have cash and investments. Those are already purely liquid. They already are cash. And then lines 2 through 5, some different kinds of receivables, accounts receivables, government receivables, grants receivables, and pledges receivables that all will be collected and converted into cash within the next 12 months. Moving down the balance sheet, we can look at FAN's long-term assets. By definition, long-term assets are those that won't be converted to cash within the next 12 months. So on line 7, they have a prepaid expense. So that's perhaps a security deposit, something that they're going to realize the benefit from in a period greater than 12 months from now. So they've recognized it as a long-term asset on their balance sheet. We also have different types of long-term receivables. So here's receivables that will be converted to cash in a period beyond 12 months from now. So maybe they did a long multi-year pledge campaign, and some of those pledges they received aren't going to be received as cash in the next 12 months, but they have already recognized them as income because they're on an accrual basis of accounting. They've recognized them as income on the income statement, and that's what leads to them as receivables here on the balance sheet. They also have some capital assets. So capital assets are oftentimes we think about those as fixed assets, are assets that are usually depreciated over time. So they have some value to our organization and they're going to last us 2 or more years. We capitalize them, recognize them as assets on our balance sheet, and then depreciate them or recognize expenses, a depreciation expense annually to reflect how long we expect that asset to last. So for example, in FAN's case, they made some improvements to their space and they are in fact on a 5-year lease in their rented space. So they've recognized, they've capitalized those improvements as a capital asset, and now they're running a 5-year depreciation schedule. So you can capitalize and depreciate fixed assets, meaning you show them, you recognize them as assets, and they show up on your balance sheet, and then you recognize an annual associated depreciation expense with each of those assets. So in FAN, we can see on lines 9 and 10, they've capitalized some building improvements, they've capitalized some equipment and furnitures as well. And then on line 11, that represents all the accumulated depreciation. So the $12,500 on line 11 at some point has been recognized as depreciation expense on the income statement. And essentially, it's considered a contra asset. It really represents the loss in value or the use of the depreciation of the total value represented on lines 9 and lines 10. So then we have the asset section divided and separated as current assets and long-term assets. And one other thing I want to point out here is that an asset section on the balance sheet oftentimes lists things in an organized way, organized by liquidity. So if we look down FAN's balance sheet here, lines 1 through 10, we see the most liquid assets at the top and the least liquid or most illiquid assets at the bottom. So cash and investments is a really great thing to have listed at the top of your balance sheet, as it is the most liquid assets. And then moving our way down the balance sheet, we see decreasing liquidity. So cash and investments are more short-term receivables, are more long-term receivables, and then our capital assets and fixed assets. So let's move on to the liabilities section of FAN's balance sheet. Now, liabilities are what we owe others. And just as on the asset side of things, our liabilities section is divided into current and long-term. Our current liabilities are those obligations or those bills we're going to have to pay within the next 12 months, whereas our long-term liabilities have maturities or due dates beyond 12 months from now. So really common types of current liabilities include accounts payable. So we've recognized some expenses on our income statement but haven't yet paid cash for them. So on an accrual basis of accounting, when we have that kind of recognition of expense before the cash payment is made, we end up with things like payables. So we've gotten the bills already, we know we owe vendors money, those dollar amounts will show up on line 14 as an accounts payable. Other really common type of current liability is payroll-related liability. This represents any unpaid wages, any unpaid payroll taxes, depending on the timing of your balance sheet and when a pay period might end for your organization. It also represents the cash value of any accrued vacation or any accrued paid time off to your employees. And we can see FAN does have some current liabilities related to payroll on line 15. Deferred revenue on line 16, oftentimes referred to as unearned income. We haven't yet been able to recognize this income, but we've received some cash payments. So maybe you have made some advanced sales but haven't yet provided a good or service. You want to recognize that liability because you've gotten some cash payment from somebody but haven't yet provided the good or service. And we can also see FAN has used some credit. They have some debt on the liabilities section of their balance sheet. And we can see that on lines 17 and 18 that they actually have some debt obligation with maturity within the next 12 months or with payments coming due in the next 12 months. So on line 17, it looks like a short-term loan that we know is coming due within the next 12 months, and the principal balance, just the principal balance of that loan, is $3,750, Whereas on line 18, we have something a little bit different going on here. On line 18, we have just a portion of a loan, the current portion of long-term debt. So line 18 of $1,800 represents the principal payment of a longer-term loan that's coming due within the next 12 months. And then if we move down the balance sheet and look at long-term liabilities, we see the rest of that loan. So really it's helpful to think about and look at, in FAN's case here, lines 18 and 20 together. So it looks like they have an equipment loan with a total principal balance of $6,600, $1,800 of which is coming due in the next 12 months, and $4,800 principal balance that's due some period beyond 12 months from now, and that's why that's classified as a long-term liability. Continuing to move down the balance sheet, our third section of net assets, keeping in mind that fundamental balance sheet equation of assets minus liabilities equals net assets. So if we take from line 13 our sum of all of our assets and take away line 22 the sum of all of our liabilities, that equals line 25, our total net assets. So we see on FAN's balance sheet that their assets are greater than their liabilities by $12,150. You can think of this as your net asset cushion, because really by definition your net assets are by how much your assets are greater than your liabilities. Or in some cases, if organizations find themselves in negative net assets, if line 25 is a negative number, what that means about your balance sheet is that your liabilities are greater than your assets. So here on the right-hand side, we have FAN's balance sheet, that same December 31st, 2010 balance sheet we've been looking at. We're looking a little bit closer at the net assets section of the balance sheet. And what we see is they've got beginning of year net assets, and then they're adding a change in net assets to get a total net asset value for where they are on December 31st, 2010. This change in net assets line item is a familiar number. It's the exact number that lives on the bottom of our income statement. So on the left-hand side of this page, we see FAN's income statement for the same period of time for 12 months ending December 31st, 2010, and their surplus on the bottom line of their income statement is $1,372. So as we talked about the importance of understanding how the income statement and balance sheet work together, what we really see through this illustration is that the surplus that FAN has earned on their income statement, they've operated at a surplus of $1,372, is equal to the amount by which their net assets are increasing in 2010. So if you operate at a surplus on your income statement, you increase your net assets on your balance sheet. If you operate at a deficit or lose money on your income statement, you decrease the value of your net assets on your balance sheet. So remember we talked about earlier in the session some different synonyms for net assets, and this term of net assets that's unique to nonprofit accounting. You can also think about net assets as retained earnings, because really what line 25 on FAN's balance sheet represents, that $12,150, is the accumulation of all of their surpluses and deficits over time. So all the surpluses and deficits for each time period on their income statement are added together and represented there on line 25. So really what we're getting here in the net asset portion of FAN's balance sheet is a glimpse into the financial performance over the organization's entire history. Another important thing to understand when looking at a balance sheet is if any of our assets or our net assets have any restrictions associated with them. So what we're talking about here are donor-imposed restrictions, where a donor says you need to wait till a certain time period to use my funds, or you need to do a certain activity with these funds. And so by doing a balance sheet as FAN has here, in a columnar format, we can actually understand total assets and then understand of total assets which of those assets are unrestricted versus temporarily restricted. So really, in FAN's case, what we see on line 1 is they have total cash of $49,558, but $40,000 of their cash is temporarily restricted, meaning they have to do a certain activity or perform a certain program at some point in the future, or let a certain amount of time pass to fulfill that donor-imposed restrictions. If you want more information about understanding restricted funds, it's one of the more unique aspects of nonprofit financial management. If you want more information on understanding how to best report and manage unrestricted funds, I really recommend checking out our coffee break webinar titled Restricted Funds, Catch Then Release. So to summarize our conversation on the balance sheet today, we've talked about assets, liabilities, and net assets, or what we have, what we owe, and what we're worth. On the asset side of things, or what we have, some questions you might want to consider when you look at your balance sheet are, what are our assets? How liquid are they? And are there any restrictions, those donor-imposed restrictions on any of our assets? On the liability sides, we could ask ourselves, what are our liabilities and when are they due? Are they current or long term? Are we going to have to make principal payments or pay these bills within the next 12 months or periods beyond 12 months from now? And on the net asset side, or the what we're worth, we really are trying to understand, are our assets greater than our liabilities? And if so, by how much? What is our net asset cushion? And then also, have we accumulated surpluses over time to build a strong net asset cushion? In today's session, we've gone over some balance sheet basics, including the contents of a balance sheet, highlighting some key terminology, and we've started to think about what are some of the right questions to ask when looking at a balance sheet. If you're looking for a little bit deeper analysis of a balance sheet, I recommend a resource that you can find at www.nonprofitsassistancefund.org. When you navigate to the Nonprofits Assistance Fund website, if you click on Resources, you'll find our free financial management resource library. The specific resource I'm referencing here that get a little bit deeper onto our balance sheet is called the Balance Sheet Cheat Sheet.